Welcome to episode 13, 3 financial statements. This is Value Investor TV podcast. My name is Becco, and this is Hari. In this podcast, our tagline is a podcast that helps you grow your wealth, and become financial independent. Welcome, everybody, to our Value Investor TV podcast. All right, let's do a quick recap of what we talked about in the previous episodes. We talked about brokerage accounts, what they are, their functions. And then before that, we talked about going public, what that means. And we talked about SEC filings, the filings you need to look as an investor to really make a judgment whether or not you want to invest in that company. So we talked about those things. Now, in continuation of that conversation about whether or not you want to make that investment, we are going to start diving into financial statements. This is kind of the bread and butter of, this is fundamental to value investing, and we need to cover it. And a lot of times people think, oh, accounting is a boring topic. It is a boring topic, but you need to really get a good handle on it. And when you get a good handle on it, at least for me, the numbers tell a story. Yep. And at that point, it's not so boring. Okay, so let's go into it. Hari, tell us about 3 financial statements and what they are at high level.
Yeah, so the 3 statements are income, the income statement, the balance sheet, and the cash flow statement. And, they all tell different parts of the story, but they taken together, complete, your picture there. And, they follow certain accounting rules called GAAP, or generally accepted accounting principles. Yep. So sometimes when you read a financial statement, the annual reports, the SEC filings, what it will actually say is GAAP earnings and non-GAAP earnings, or GAAP rules, non-GAAP rules. So sometimes those non-GAAP things are actually how the company may evaluate their financials and so on. But for the most part, they have to report everything based on these rules, the GAAP accounting rules. So that's GAAP for you podcast listeners out there. So you may see that term. So just be aware that there is a difference, but there are certain metrics that they have to report, and then others that they may add on top of it. For the most part, it's best to stick to the GAAP rules and use those when evaluating between companies, because sometimes the non-GAAP rules, they will play with the numbers and things like that.
Yeah. It depends on the industry as well.
Right.
Different types of industries will have different non-GAAP rules.
Yeah, exactly.
Okay. So tell us about what they are kind of in specifics, telling us these financial statements, the fact that they're telling us a story about the company. Yeah, so the main thing is that the financial statements tell you a story that is is dependent on a time period, right? And so when you look at it, the income statement is over a time period that is defined, as it could be a quarter, it could be a month, it could be a year. So there's quarterly and annual, and it's for that time period you get a snapshot of how in the case of the income statement, how much money did I make? Yeah. And generally from operations of the business, not from how much money did I make selling something off, or that isn't part of the normal operations. Then there's the balance sheet, which is telling you the financial health of the business. So that is a different statement, because what it's really saying is how much money do I have and how much money do I owe. And then lastly is the cash flow statement, which is a different statement altogether. And what that is actually saying is that in the income statement, it's when I ship a good, I can charge it, as revenue, but I may not necessarily get paid, right? So think about it: when you buy something on credit, you may get to pay over 90 days or 180 days or something like that. Businesses have that with their suppliers, and they have that with other things. So when they sell an item, they are selling it, and then they mark it on the income statement. But on the cash flow statement is when they actually when the money actually moves in and out of their bank account. So right now that may sound like a subtle difference, but when you start thinking about timing of things, it becomes really important, because businesses, for the most part,
will buy a bunch of stuff and then pay at the end of the month or end of the quarter. And because lots of different groups are going to do, are going to be involved in this supply chain, those payments may, when they get paid, may, affect, how you perceive it. So for the most part, what you're looking for with these stories that the financial statements are telling you is not necessarily what 1 year statement is saying, but multiple years together. You may want to look at averaging some of the values, or to just kind of see, because as every business, and I'm sure you're as an individual, every year is a little bit different. You make a little more money this year, make a little less this year, and that's all dependent on a lot of different factors. Businesses are no different. So just paying attention to the statements can tell you a story of how the company is doing over a longer period. Yeah.
So kind of just to recap, so financial statements, when we talk about financial statements, we're basically saying there are three financial statements: income statement, balance sheet, and then cash flow statement.
Yep.
There are three statements, and we generally lump them as financial statements. And they serve different purposes, and we're going to talk about those here. And Hari said they tell us a different story, each of them, and you need to look at the whole picture, all three financial statements all together to really understand the entire picture of the company.
Yeah.
So why don't we look at income statement first and kind of go through it with an example of the hot dog stand.
Yeah,
at high level.
Yeah, so just so everyone's clear, we are going to go into detail on each one of these. So this is just a high level overview. The next few episodes we'll be talking about income, balance, and cash flow. So talking about the income statement, depending on where you are in the world, in the U.S. we call it the income statement. In the U.K. and parts of Europe, they call it the profit and loss statement. So like it says, the income statement is actually telling you, for a particular accounting period, how much money did the company make from its normal business, day-to-day business, and that is over a period of time. So quarterly or annual is what you'd typically see. Internally, businesses may actually report these numbers monthly or weekly even, but for the most part, what they're looking at is monthly or annual. Quarterly or annual, because that's what they'll report in to the SEC. And there's some terminology here that's you're probably familiar with or you've heard of before, but you may not have put it together. So there's the top line, which is how much money did they generate from sales, and then bottom line, which is the profit that they generate after they pay all of their expenses. So the top line is called sales or total revenue, or net revenue, depending on how they book things. And then there is different types of profit. There is gross profit, operating profit, and net profit. So in essence, you start with a reverse pyramid. So at the very top is the pyramid is much wider because it's upside down, and that's where you see revenue, and you start cutting down expenses to as you pay your suppliers to pay make the items. You're paying your employees, you're paying for rent, you're paying for insurance and legal fees, and so on. And then at the very bottom is how much profit, or in some cases loss, your company has.
Yeah. So the top line, we talk about this a lot in English. You say, oh, the bottom line is blah, blah, blah. The bottom line is that. This is where it comes from. The bottom line. So bottom line is you start from the revenue, you deduct all the expenses, and you come to the bottom line, which is the profit, the profitability of the company.
Right.
And that's where the terminology bottom line comes from. So income statement, just to touch on key points, income statement is how the company performed in a given period of time.
Yep.
So in the case of hot dog stand, a hot dog stand could made $1,000 in a month, in a year. So it's always based on a time period.
Yep.
And that's important to understand, and that is a distinct difference between the next statement that we want to talk about, which is balance sheet.
Right. So think about your balance sheet. If you have a bank account, you get a statement from the bank, monthly or quarterly, and that balance sheet is actually a snapshot in time, right? And so on this date, this is how much cash you have in the balance on your books. This is how much you owe to your creditors, and this is how much is left. So there are three critical terms here that you're probably familiar with: assets, which are what you own; liabilities is what you owe; and then equity is the difference between the two. So that is what you own after so you own the asset, but you also owe money on those assets, and then you get the equity. So we talked about the equity in our when we were talking about financing our hot dog stand, and so a lot of people get confused by these two terms because they're saying I'm selling equity. The two are actually the same term, but it's a different way of looking at it. And when we talk about the balance sheet, we'll kind of explain that a little bit better. For now, understand that, think about it from the if you've heard of, when you have a mortgage, you buy a house. The house is worth $100,000, let's say, but you pay $20,000 in cash, and you get a loan for $80,000. The asset there is $100,000, and that doesn't change. The liability is $80,000 because that's what you owe, and $20,000 is the equity in the house because that is what you own after subtracting your liabilities. So that, just to think about it that way, there's obviously a lot more types of assets within and liabilities within those categories, which we'll go into greater detail next time.
Yeah. So again, balance sheet is a snapshot in time. It's like a bank statement. It's what you own, what you owe. It captures all of that in a statement. So let's look at the third statement, the last statement, cash flow statement.
Right.
Tell us about that, Ari.
So cash flow is actually when the cash moves in and out of your account. So this is different actually than the income statement. And the subtleties are sometimes lost on people because they're not, they're not familiar with it, because the income statement is almost a little more abstract in some ways, whereas the cash flow is just measuring when does money move in and out. So in a cash flow statement, what you're seeing is how much money in each category moved in either a positive or negative direction in that time period. Whereas in an accounting accrual basis of accounting, so let's step back for a second. There are two types of measurement when you talk about it. So in the income statement, we're talking about accrual accounting, which is recorded when the revenue is, when you ship the item, regardless of when, so if somebody buys a product from you and you ship it in, year one, but they don't pay you till year two, in year one, in accrual accounting, you will mark that on the income statement, and in year two, you will mark it in the cash flow statement. And so on the cash flow statement for year one, there won't be any change because you have shipped the good, but you haven't received any payment. But maybe what you did pay for was the cost of the goods that you had to purchase to make it. Whereas in the in the cash flow statement, there won't be anything recorded in year one, but in year two is when you actually get paid. Mm-hmm. So the difference here is pretty important, and it actually tells you a different type of story when you're watching it. So paying attention to both of these is really important. Mm-hmm. The other thing is that, to kind of bring all of these statements together is they're all linked in some way. We'll get into this in more detail, but just to give you an idea, let's say we're making hot dogs here, and we buy buns and we buy the meat. So that gets marked as inventory, which appears on our balance sheet. We deduct money out of our cash flow to pay for it. And then when we actually sell, the hot dog, we actually record it on the income statement. So we convert what was inventory into, and if the purchaser who bought our hot dog is buying on credit, then we would actually mark up other areas as assets that we have. Like we're expecting cash to come in, and that's called accounts payable. So all of this stuff is related to mostly around the timing of when events occur. So 50 years ago there was no cash flow statement, and this was something that was lobbied for because it helped clarify a lot of the picture, because it used to be just income and balance sheet. Now a cash flow statement kind of just tells you where your money is moving. And we've talked a lot about this, about the operations of the business is where you see cash flow moving in and out. But the business also has to invest, and when they are investing in themselves, they're buying other businesses or buying equipment to supply their business that may last for a long time. That too will link to the balance sheet, and we'll explain that in a little while in another episode. And then finally, there is a cash flow from financing activities. So, when you borrow money, that money will appear in the cash flow statement as money that was coming in. Even though you owe money on that, you will put that in the balance sheet as an asset, the cash, and you'll put a liability on the balance sheet as well, indicating that you still owe money on that. Now, it won't have any impact on the income statement because you're not making money off of that from your operating activities. So, there's three parts of that, operating, investing, and financing, and we'll go into a lot more detail when we start breaking down the cash flow statement.
Yeah. Excuse me. So that was the cash flow statement. Hari touched on a really important point about interdependence of all these financial statements. Money moves around in cash flow. That is booked in balance sheet and also impacts an income statement in some instances. And so really understanding the three financial statements all together is very important to understand the entire picture of the company. And like he said, it's very dependent on each other. So understanding that, very, very important. Okay, we'll go into more detail in the subsequent episodes. We'll do an episode each, or maybe more episodes each per statement. Income statement will be an episode dedicated to that, as well as balance sheet and cash flow statement. So if you didn't catch all that nuance, don't worry, we'll get into more detail down the road. Okay, so that's it. Anything else you want to add here?
No, I think we'll cover it all again. So
okay, great. Thank you for listening. Episode 13, 3 financial statements. And if you like the episode, please subscribe to our channel. And we'll see you on the next episode, episode 14. Thank you.
Thanks, everyone.